I am absolutely thrilled to be moderating this panel with such an illustrious group of friends and leaders in various different spaces, emphasis on various. So the purpose of this panel, we are going to be discussing some of the newer, more innovative, more emerging building blocks of the capital stack supporting decarbonization companies and solutions. And so we're going to cover the opportunities presented by IRA tax credits. We're going to cover the rapidly emerging world of insurance for carbon projects and beyond. We're going to cover equipment leasing and how that can be brought to bear. And we're going to cover royalty payments and how they support sustainable long-term capital for projects. And most interestingly, I think, we're going to start to have a conversation around how these are not only converging, but coalescing and being brought to bear together into capital stacks for projects and for companies. And so with that, I'm going to kick it off to the various panelists. We're going to do a little bit of a mini interview or question session with each one so that we get a little bit of a short deep dive into each of these spaces before talking about how they intersect and are working together. And so we'll start with Alfred, the CEO of Crux. Great to have you here. You want to tell the audience about Crux for a minute?
Yeah, so I'm Alfred. Crux is a new marketplace platform for the transaction of the transferable tax credits created by the Inflation Reduction Act. Inflation Reduction Act creates hundreds of billions of dollars of credits that are now transferable for the very first time, but a new market needs to form around those, and we're the infrastructure layer to do that.
Amazing. And so, yeah, Crux is really the premier marketplace focusing on IRA tax credits, which many of us heard a bit about earlier from Congressman Richie Torres and Dr. Vanessa Chan. So can you give everyone an overview for the uninitiated about the IRA and how the tax credit market is emerging? Maybe give some key stats around how the size of the market now, where it's projected to go by 2030, and the different market subsegments.
Sure. I'll do 100 years of history in 2 minutes here, and hold me to that. So we have been using tax credits for energy policy for a very long time, since around the time of World War I for oil and gas. It is not necessarily the most efficient mechanism of subsidy. It has really strong political economy features to it because it tends to be widely supported. But the issue with tax credits is that they apply against the tax liability of the company that gets them. And many companies that develop don't have a tax liability to be able to consume the credit. So the result of that has been that you needed to be an investor in the asset in order to redeem the credits that are associated with it, which led to the formation of this market called the tax equity market, which is largely controlled by the largest banks in the United States. It is still a valuable tool in wind, solar, storage, to a certain extent, 45Q. What the Inflation Reduction Act did is it is the largest climate law passed by any government in the history of the world, depends overwhelmingly on tax credits. The credits make up about 2/3 of the law. And as Congress was looking at this huge increase in the number of credits that were going to be available to project developers of all shapes and sizes, they were looking at the tax equity market, and it was not sufficient to be able to take that supply of credits that were coming to the market. So they created this new mechanism of transferability. We anticipate that market in 2023 was about 7 to 9 billion of transactions that occurred. We think it'll be about 20 to 25 billion of transactions that occur this year. And really, of relevance to this panel, it fundamentally changes the way that the capital stack forms around these projects, because the tax equity is no longer required in order to develop it. You can now just sell the credit directly for cash.
Great. Can you talk for a minute about any of the following? Average deal sizes in the market, the segments of the tax credit market where you see the most transactions, and there have been really phenomenal projections around how big the IRA tax credit market can grow. Some of it put out by you guys, because Crux does phenomenal research if anybody wants to learn more. So I think I've seen $50 to $80 billion a year by 2030. What are some of the challenges that the market may see or faces now to actually achieving that growth?
Yeah, so why don't I take it in reverse? So 20 to 25 billion of supply sold in 2024. That'll grow by 4 to 5x by the end of this decade, by 2030. And a lot of that is coming from new technology types that are going to enter the market and some very large projects, including offshore wind projects that themselves generate billions of dollars of credits. So there's a ton that is coming to the market. That market needs to grow on all sides, right? So there needs to be many more buyers that come in, largely Fortune 500 companies that participate and purchase the credits. There are obviously going to be new forms of intermediation, new insurance products, new financing products that emerge. But for now, the market is already existing in quite a healthy way. We're seeing average transaction sizes between 20 and 80 million, but also deals transacting that are very small. So we, Crux, have done deals everywhere between 70,000, which we definitely lost money on. We mostly did it to prove that it was possible to transact on that small of a scale, all the way up to the hundreds of millions. And that's really encouraging for the market, because the tax equity market was not accessible for projects that are below 50 million in size. So this really does democratize it to new technologies and smaller sizes.
Amazing. So we're all experts on the IRA tax credit provisions now. Shifting gears to insurance and how insurance is being brought to bear in the carbon markets. The introduction of high quality and specific insurance products for carbon projects has been, I think, very revolutionary and transformative for the market. So James, can you, and Kita is, of course, a leading provider of those insurance solutions. Can you talk about the biggest risks that companies are looking to insure against?
Yeah, sure. Thanks, Dana. Hi, everyone. Great to be here. Just quickly on Kita. So we're an insurance firm. Our mission is to de-risk high-quality carbon projects and enable them to scale. And we think insurance is one of those keys to unlocking the financing that the sector needs. And to do that, we look at what are the risks of the market as they evolve, and how do we solve some of those pain points as it grows with insurance. So what are the risks over a life cycle of a project? What are the risks that the different stakeholders may have? And what are the risks for different types of carbon projects? So when we think of the insurance products, we're always thinking about risk. Obviously, the headline one is reputational risk. Corporates they want to do the right thing, and they don't want to be pulled up by The Guardian or the New York Times for having invested in a project that turned out not to deliver. But it's hard to insure reputation. We think insurance has a role in providing an extra layer of due diligence for those corporates to act, acts as sort of extra stamp of quality, and also it's a backstop if things go wrong. So reputational risk is a very broad one. For us, we've drilled down into 4 key risks, as we said, in the market. Starting with delivery risk. So if folks are investing into a project to receive carbon credits in the future, there's the risk that you don't get either all or some of those credits. And that could be because of a multitude of things. It could be the developer has defaulted, they've gone insolvent, they've abandoned the project. It could be classic insurance-y things like wildfire, drought, pest disease, earthquake, etc. Or it could be the vagaries of the carbon market, things like methodology change. So we built a product to cover that risk, and that can go out sort of 10 years or so in terms of policy tenor. And then if there's a claim, obviously there's a financial investment that's put in up front, but the actual payout could be in cash or could be in like-for-like credits, depending on what the insured needs. So that's delivery risk is a key one. Credit risk is a key one. We're starting to see more banks entering the space, and we're building a credit risk product for them to encourage more lending. So they could be lending to project developers, could be lending to some of the folks structuring the deals. And that's a credit risk that the bank takes on. But the underlying risk is whether the developer can deliver on the project, and if they can't deliver, they can't sell the credits, therefore they can't repay the loan. So that's an angle. And the insurance could be very valuable there because less in the US, but in UK and EU, banks can actually use credit insurance as capital relief, which means they can reduce the reserves they hold and hopefully do more lending. Political risk is a key one with the implementation of Article 6. So there's the risk that the host government in the country where the project is located either nationalizes the project or they cancel the licenses that project has to operate, or around Article 6 specifically, if the project is looking for corresponding adjustments and they aren't provided, or they're provided and then revoked, then there's insurance products there. And then the last one is around reversal risk. So the risk that once the credits have been issued, the underlying project suffers a reversal through wildfire or, say, leakage of underground injected CO2. There can be insurance products directly for the buyers of the credits or the sellers of the credits. We're also working with the carbon standards who manage and maintain the buffers, and we work with them to both help assess what the underlying project contributions should be into the buffer. So the buffers make complete sense to us. We just think maybe they should be risk adjusted, and that should help incentivize good behavior. A better run project is hopefully a lower risk and therefore shouldn't have to take so much of a haircut. And then the other angle is once the buffer is established, it might be that in 1 year, in 2 or 3 or 5 years' time, there is a catastrophic loss that affects one very large project or a series of projects. So we've built an insurance product for those buffers there. But there's a few other ones that are emerging as well around invalidation or things like parametric products around specific perils. But those are the key themes that we're seeing the traction with so far.
That's excellent, because interwoven through, I think, all of the conversations we've had today has been the lack of standardization and a lot of different kinds of risks that come to bear on carbon projects. And so I'm assuming you see insurance and all of your various insurance products as a way to mitigate some of the volatility and lack of stability in carbon markets to enable people to invest.
Yeah, and I think that's hopefully a key thing where insurance can add value. It's just there's so much uncertainty. Folks are looking for comfort, and insurance is a tool to providing some comfort. So the role of insurance is to help manage the volatility. Those hopefully the events that don't happen, but when they do happen, can be catastrophic, and it helps to convert the uncertainty of these kind of future losses into the certainty of an insurance premium. So hopefully by unlocking that confidence, extra sort of layer of due diligence, but fundamentally being a backstop when things do go wrong, folks can reload and redeploy and reinvest.
Amazing, thank you. So we have IRA tax credits, we have insurance. I'm going to shift gears to equipment leasing. So I'm thrilled to have Thomas here from CSC Leasing, which is a massive equipment leasing company. And equipment leasing and equipment finance is a key piece of the capital stack for many kinds of infrastructure projects and spaces for project developers. And I know CSC recently made the decision to start moving into the climate tech space and supporting the equipment stack in the climate tech space. So if you could talk more about that, that would be great.
Yeah, absolutely. Thank you, Dana. And the last time I spoke was about a week ago, officiating my brother's wedding, and you guys are definitely a less intimidating crowd and better dressed as well. So, but thank y'all for having me. So just to kind of give you all a background of CSC, so we're a 40-year-old family-owned business out of Richmond, and I guess ever-changing, as you could say, to where we started the business offering $2,000 lease lines in the forms to support phone systems and computer systems. Now, as of a few weeks ago, we've grown to over $1 billion of assets under management, and that is through pivoting what our focus was, and that is now supporting early-stage companies who are capital-intensive. Specifically, a lot of my role is in the greater clean tech and climate tech space, where companies are very capital intensive, and we're solving a need for them that they're having to deploy oftentimes millions of dollars on depreciating assets. And what we're doing is solving that problem for them to pretty much own depreciating assets using equity dollars that equity sponsors oftentimes don't want to be involved in. So we're able to fit in nicely with their capital stack, especially in this ever-growing climate tech community that has to continue to be capital intensive. To combat climate change, and I've heard this from a few different speakers over time as well, is it needs to be a capital intensive industry. It really can't all be on software. There's got to be some hardware components to it, which all of you know. And it's been a great way for us to get in this space and support these innovative companies, especially being a resource as well for them. But that's kind of how we've evolved and have been able to really plant our seeds in the space today. And talking about how large we've grown, we're also able to grow with businesses from the very beginning at their seed stage level, where they might have needs as low as $50,000, $100,000. But ultimately, they're obviously and hopefully going to grow, but we can support those early stage needs at a much lower level. We don't have, a huge, bare minimum size. We're wanting to work with as many as we can, especially in this space, because it's ever changing and it's happening, right now. But yeah.
That's great. Within the broader climate tech space, are there examples of actual equipment that you've started to finance or to lease?
Yeah, absolutely. I would say in the greater manufacturing space, with even direct carbon capture technology itself, EV charging stations even, which I'll kind of maybe allude to after this, but we are very agnostic in the type of equipment that we finance. And so we're not necessarily looking for the specific equipment. We're looking for the right early stage companies to fund, to work with, and support them in their needs, to be diverse in the types of equipment that we can finance. But just to name a couple examples in the clean aviation space right now, alternative construction materials, et cetera. So we're ever changing and trying to be as versatile as we can, especially as it continues to change.
And just to sort of hone in on this for the audience, what are the key benefits of leasing equipment or assets versus traditional financing when it comes to decarbonization, but really when it comes to any equipment?
Yeah, absolutely. Great question. At the end of the day and the beginning of the day, cash is king. Every early stage company knows that. And we have a way for you to be able to pay for your equipment over time. You don't want to deplete your cash at day one. It's going to always be an evolving process for each company, and you're going to need to stretch runway. We're giving you an ability to have a lease line where you can draw down on it as you need without depleting that early stage cash while you're talking to equity investors, continuing to fund through other forms of debt. And so we're fitting really nice into the capital stack, and we give optionality. So in our leases, you have the option to return the asset to us at the end as a way to be flexible at the end of the lease in case it's something you all don't need anymore. And as a startup, you need options and you need flexibility, especially as you're going 100 miles an hour, 200 miles an hour.
Great. That was a great overview. Thank you. Rina. Rina is from Green Star, which is a carbon credit royalty company. For the unfamiliar or the uninitiated, can you talk about how royalties work in this market?
Absolutely, and thank you for having me here. This is a very interesting panel. I'm actually very impressed with all these different solutions and products that are here. I will admit that I am equally, as a lot of people here, learning about their solutions. I'm familiar with KETA. It's been really interesting to learn more about the IRA, tax credits, how that can be used, the leasing equipment. And it's just, making new friends. I think new partnerships are going to come out of this panel, for sure.
Amazing.
Yeah, so royalties. Yeah, so royalties is actually, it's essentially a revenue share model. And what it is that you provide capital, X amount of capital, and you get a return over a period of time for that upfront capital that has been provided, and that return can be in kind or in cash for the monetary value of the asset. So essentially, the royalty model has been around for a long, long time. When I first thought about royalties, I thought about music and the royalty space in the music, and we all hear about how amazing that could be if you got royalties on a song. But it's actually a very popular model in the precious metals as well as oil and gas. And the way that it has worked, and in the last number of decades, you're essentially helping finance the exploration of oil sites or mining sites. And by doing so, you're allowing for these products to be developed and to be achieved. So we're bringing that very same idea to the carbon space. And what we are looking to do is two things. Help projects help the supply to exist for all the offtakes that we're hearing, as well as allowing investors to have an exposure to the carbon credit market space as well.
And how do you ensure that royalty payments do create long-term value for both the investors and for the project developers that are generating the credits?
So by nature, royalty agreements are usually somewhere between 10 and 20 years. So by definition, they are long-term. So we're looking at a long-term alignment here. For the investor, what this means, first and foremost, for some investors, we're providing them with an opportunity to participate in the carbon markets, get exposure to a diversified, due diligence and well-managed portfolio, as well as allowing the investor to have exposure to projects that will increase in volume. Hopefully there's going to be optimization, price, and all those sort of different variables that come into making this a successful market. At the same time, with that exposure, they're also not being exposed to the day-to-day operations of a project, right? So they're not exposed to operational costs or capital expenditures. They will get a return irrespective of increase in costs, for example. Now, for the project developer or the project owner, first and foremost, we're providing that capital up front, right? So if you have an offtake agreement, that's fantastic. That offtake agreement is going to pay once you deliver the credits. In our case, we'll provide you that capital so that you can actually get that project off the ground. And by the nature of the royalty model, we're not restrictive in terms of how you're going to be using that capital. It depends on what your financial gap is and how we can support that gap. So it could be for any sort of use. It could be for balance sheet cleanup, expansion, incentivizing others to use your product. I'll give you an example. In the nature-based space, earlier this year, we announced an investment in a company called Native State, and that's an IFM program. What we're doing there is we're actually providing a per acre payment for landowners, small landowners, to enroll into an IFM program. In the region ag space, regenerative agriculture, we are subsidizing the use of a probiotic that leads to soil enhancement and greater soil organic carbon sequestration by providing what would be sort of like an equivalent to a subsidy to the product itself. So therefore, there's no cost to the grower to actually use this product, but at the same time, you're getting more product out there that's reducing the use of fertilizer, so you'll have other benefits being generated for it. So that allows deployment. It allows, if I think of more in the technology space, well, can we help finance some of the technology so that it gets there to the end user? And then you are deploying your solution out there. In addition, when we enter into royalty agreements, the way that we structure these agreements are long-term, but we're also looking at structuring it out at a conservative pricing curve. And that allows us to be aligned in the good and in the bad. So if the price goes up, we'll benefit. If the price goes down, we benefit. For the investor, we're still generating a revenue. For the project owner, then we are still providing capital.
That's great. Very clear explanation. So thank you. And I'm going to reiterate what you said at the beginning of your remarks, which is that it's great to bring all of these folks with disparate solutions together on a panel. The reason that we did this is because we at Flowcarbon, as we work with clients, we're primarily focused on accessing the capital markets and specifically institutional debt for them and private loans so that they can scale, right? This is scaling capital. But increasingly, as part of that conversation, we are hearing and helping and solving a lot of needs related to tax credits and insurance and royalty and even equipment leasing. So this is a real-time exercise whereby the companies on the ground that need capital to scale, right? They're beyond that initial equity check. They're ready to scale to new facilities, scale existing facilities. They're ready for project level capital. They need more. They need loans, of course. They need debt, but they need more than that. And so that's sort of the spiritual underpinning of this panel. And so with that, I want to kind of go one by one and say, how do you see your product or solution playing into the need for scalable financing for decarbonization solutions? And also, bonus points, if it's intersecting with any of these solutions or with equity and debt, more traditional capital solutions, how it's kind of playing with the other pieces of the capital stack. So Alfred, we'll start with you.
Totally. So I was thinking about what makes this panel interesting and what makes finance around this stuff interesting. And it struck me, if you're a simple company, like a normal company, you sell maybe 3 things. So like if you sell desks, you make desks and you sell them for money. You might also sell your equity. You might also sell a lien against the company, your debt. If you're in the energy space broadly or the project development space around carbon, you sell like 5 things. You sell all of those three things, except in place of desks, you sell energy. And you might also sell the environmental commodities, the attributes that are associated with the project, the RECs or the offsets, and you sell the tax credits, right? So you have three other things that you're selling, the energy, the tax credits, and the environmental commodity, that at some level have some amount of timing risk associated to them and some amount of pricing risk associated to them. And the result of that is that you need flexible forms of financing that integrate with each other, because ultimately the sale of any one of those things may be the way that the loan against another one of them is taken out, maybe the way that the project is financed. And so there is just this fundamental integration of all of these different attributes of a project that, if you break it down to its simplest essence, is really just how the company can access capital most efficiently against the things that it has to provide to the market. And I think in some level, that's what we are all doing here.
That was very professorial. I like that a lot. Thank you. James?
Yeah, I think I've been in insurance too long, because I can't see a future without insurance in this market, so nerd alert. But I think it's just the way we think about carbon, the projects themselves or the credits, it should just be looked at as just another asset or liability. And like with other assets and liabilities, you get financing, you think about risk management, and then you think about insurance. So eventually, it will be part of the course. Our job is just to help be proactive in pushing and helping to see what projects might be insurable, and giving our view on how to mitigate those risks and offering some of those kind of risk transfer solutions. So that's one element. And then I think with the folks on the panel, loads of synergies. I mean, we're on the DAC space. Interesting to see how the sort of 45Q tax credits work, and we're sort of building a product that would look at the delivery of the credits, but also there might be a delivery plus 2 years or so to secure that, the 2 years of underground storage that would release that 45Q. On the equipment financing, you're working in the biochar space, and also DAC on how do we build lease financing schemes, and then we would work with a financing partner to de-risk them so that can help that program scale. And then on the streaming side, anybody who's putting money up front, either capital or prepayments, that's where we sort of built our sort of bread and butter of our product. So hopefully that resonates. But.
Great. Thomas?
Yeah. So I think the future of CSC's involvement with this, emerging market is a lot through education itself. And a lot of what we have started to do is work with innovation and accelerator programs just to be there as an educational resource. Because a lot of these early stage companies don't understand the best way to get funded. And I think the best way to do it is integrating all of your resources to be able to have, to select certain ways that make the most sense for your business. Not trying to bring in only equity that's going to end up diluting your business to then fund your hardware purchases. But we're just trying to stay with the times, in the sense that we want to be able to be a resource for companies as all of these new technologies involved, and stay agnostic in the sense that we don't want to just stay on specific technologies, but be open to newer ones and see how we can get involved in a deeper way. One of our leasing models is called a hardware as a service model. And I think it's really relevant in the space, from biochar to EV charging, to pretty much all of them, to where you're deploying a proprietary asset, and that bill of materials cost is oftentimes through the roof. And so we're creating a way to fund those initial technologies that they don't have to deplete their cash in that sense. And so that's just an example of us being able to try to educate companies of, this is a way that you can turn your assets into liquidating your assets in that sense. And to kind of do the last question of integrating all of us, I think we all overlap in so many different ways in the initial part of integrating in the cap stack, and we all offer very diverse things. And I think it's we encourage early stage companies to really see how we can all be integrated in the same sense. And I think that's always going to be ever changing too, and up to us to change with these companies that are changing the world at the end of the day.
100%. I actually have a follow-up question for you, which is, do you find that early stage companies know about equipment leasing and equipment finance, or are you often educating them that this is even a solution that's out there?
Yeah, great question. what I was referring to earlier is it surprises me how much education we do, because these companies are, so gung-ho about getting their company started that the little things they'll forget about, and the little things, and this point is, what types of financing they're going to provide. And so we partner with these companies, as I was referencing earlier, and accelerator programs to just be a resource for them so they understand what leasing is, not necessarily to say, hey, here's CSC, but hey, think about this as you scale. Because there's going to be a lot coming at you, and you need to diversify your capital stack as best as you can, especially oftentimes when these aren't really as bankable of credits you're working with. So a lot of it, to answer your question, is new education for them, and I'm surprised more and more each time I meet with more and more companies, and it's I want to push it harder so they can understand it's an option.
Same. We find the same thing. Yeah. Rina.
So I think for us, we're really looking to be a leader in the royalty space, to be honest. I think that this is a model that will gain some popularity. Why? Well, we're not taking equity, right? We're not alone. We give you capital, and we share in the long run with the success of the company. In addition to that, fitting within the capital stack is the fact that if you have a royalty company, you're sort of getting that endorsement of a third party providing you capital and de-risking other forms of capital coming into that stack, right? So I think that there is a very interesting opportunity for the royalty model to come into the space. I think that even if I wanted to apply to who's here on this panel, I think that if we use the royalty model, it could be used as capital could be towards leasing equipment financing, and then we get it insured with KETA, and then we share on the revenue side on the tax credit on top of the tax credit on the credit sales as well, right? So it fits really nicely. I just think that we're so, you want to go to a bank, but banks don't want to take the risk. But then if we de-risk it with KETA, and then you have a royalty agreement, and then you have all these other different sort of revenues and capital already coming through, then it'll help you scale up. And the nice thing also about the royalty model is that, we want it to be opportunities that can also expand. So one success can lead to multiple opportunities. So we can start small, but if that's going to unlock potential, then there's replicability, and then we can support the expansion of projects.
Very well said. I think we can open it up to questions, if there are any. There is one. We have a mic coming, but that was a short question. Who is not on the stage?
Yeah. So I know about 1 out of the 4 kind of solutions here, and I'm just wondering, who else would you have invited? What other types of solutions are out there that aren't represented here?
That's a great question. I could answer, and then anybody else can answer. Who's missing? So not here are traditional equity investors, venture capitalists, lenders, debt, like there's the whole traditional capital stack. These are and they're coming next, actually. That's the next panel. Other innovators, who do you think who would you consider other innovators? Philanthropy would be one, but.
I mean, for us, in terms of assessing risk, then the MRV, high quality digital MRV, that's great. And we really rely on that for doing a proper assessment of underwriting, and then the ratings as well. So we'll be looking at, when we're assessing a project, the MRV, the ratings, and then some different physical and credit risk factors. But I think they're all doing great work as well.
Agreed. Yeah, Rina?
I wouldn't necessarily say who's not, but there's this other area of finance that's coming out more in the development space that we see it more for development purposes. It's called blended finance. And it's all about de-risking capital in high-risk countries. But that said, there is a need for blended finance in North America as well, right? Especially when you have large investments, large CapEx and OpEx type costs associated with some of the technologies that we know with engineered removals, for example, DAC is very expensive. And it's really difficult to finance because you're looking at a large investment with 8 years of at least, permitting, licensing, commissioning, so you're really looking down the line. But with the blended finance space, it's essentially a different form of building that capital stack through philanthropy as well as institutional investors, that they're still seeking a return, but they're also trying to diversify that risk for each of the lenders or finance providers, to put it that way. I think that would be an interesting space.
Large companies. So in our space, large companies will be the overwhelming buyers of the tax credits. There are more financially motivated things that they can do. They can just buy it for the savings on the credit. There are more impact-oriented things that they can do, invest in certain areas, pay more for the credits than they might otherwise pay. And then also on both energy offtake and other things that they would do to offset their energy profile, they're just a critical part of the whole equation.
Yeah, go ahead.
Yeah, and I'll add quickly, I think in part of what I was sharing is, innovation hubs themselves and what they're seeing from these companies, what questions they're asking, what capital they're looking for, what problems they're running into. I think they would bring great perspective and, have a holistic view of all these types of businesses that they see in the space that are going to market every single day.
I love your question. It was kind of like a law school question where it's like theoretical and we all have to come up with something on the spot. I felt like I was back in law school. So an answer that I'll give is what I said before, which is philanthropy. There is a really important role for catalytic capital coming out of foundations to play in the capital stack. And then secondly, there are really interesting government programs. Behind the IRA is an obvious one, but there's something, for example, California has an iBank, which has a loan guarantee program for green companies or climate tech companies where they'll guarantee 80% of a loan up to $5 million. It's a very prescriptive formula, but that can play a really important role in a capital stack for qualifying companies. So there's really cool government programs and pools of capital that I think would belong up here on this panel. Other questions? Yeah, great question. Other questions? Yes, you could. Do you speak loud? Just shout it out.
Yeah, I can speak loud. You guys hear me over there?
Yeah.
Awesome. So I'm Xavier Ashford, Columbia Climate School, master's student studying climate and energy. This one's for Alfred. With regard to the tax equity market, you mentioned that it's dominated by bigger players and financial institutions. Do you think that kind of affects the discount that's applied to the tax credits on their face value in those transactions? And what are some of the ways that we can make it so that smaller developers or more risky projects have better access to those kind of transactions?
God, what a good question. Okay, so the tax equity market, I mentioned earlier, you couldn't monetize the credit but unless you are a member of the capital stack, so an owner of the asset was the only party that could receive the credit before it became legal to transact them. What that looked like is that usually large banks would invest in the asset and then redeem the overwhelming majority of the tax credits. So they might take 95% of the tax credits associated with the deal and the depreciation and the cash, some of the cash coming from it. And so it kind of looked like a loan that was made into the project that was paid back in 3 ways. And what the IRA did was say, that's a very complicated structure, that only so many institutions in the United States, really meaningfully the largest banks, Bank of America and JP Morgan, make up 50% of that market even still, that we needed to open the door to lots of other companies and sellers, so different kinds of developers building different kinds of technologies to sell their credits into an open market. And that became legal on January 1st of 2023. You couldn't do it before then. And so now the price is set by the market, where you list your credit, you receive bids on those credits, they're sold at a discount to $1. So you might sell $10 million worth of credits for $9.2 million. And if you get a better offer, you sell it for more. If you don't, then you take the one that you've got. And so that is a much more dynamic mechanism than what is essentially a lending market in the form of tax equity. As far as unlocking capital for earlier stage projects, the tax equity market, given its complexity, it might take $1 million of legal work to do one of those deals. So very few developers, only the largest ones, had access to the market. Now it's much simpler. So smaller credits are able to monetize directly in the market. Great question.
Okay, with that, we're going to wrap. Let's give a round of applause to these amazing panelists.
Thank you.